The U.S. markets are currently closed. As of the market close on Friday, October 31, 2025, at 4 p.m. Eastern Time, Plug Power, ticker PLUG, finished the session at $2.69 per share. This marked a gain for the day of just over 1.5%, closing near the high of its daily range, which spanned from $2.56 to $2.72, all on significant trading volume of over 94 million shares. But that simple closing price completely masks the reality of what this stock has become. One of the single most intense battlegrounds on Wall Street. The expectation is that Plug is the future of green hydrogen. The reality is that nearly 1/3 of its entire publicly traded float is currently held by investors betting it will fail. This isn't just a growth stock, it's a high-stakes proxy war between a vision of a green industrial future and the cold, hard mathematics of persistent, massive cash burn. The recent volatility is a direct result of this tension. While Friday was relatively calm, the stock exploded in early October, hitting a new 52-week high of $3.34 on October 3rd, a move of over 37% in a single day. That rally was sparked by a decidedly bullish analyst note from H.C. Wainwright, which upgraded its price target to $7, citing the rising cost of traditional electricity as a powerful tailwind that makes green hydrogen more economically competitive. This is the narrative that long-term holders cling to. The macro environment is finally turning in their favor. Yet this optimism is colliding with a wall of institutional doubt. Just 10 days after that surge, on October 13th, Clear Street issued a downgrade, cutting the stock to hold and warning that the valuation had become stretched after the recent blistering rally. This perfectly captures the analyst divide. On one hand, you have firms like H.C. Wainwright looking at a long-term potential where revenue could grow substantially. On the other, you have Citigroup maintaining one of the most bearish stances on the street, with a price target of just 75 cents. This isn't a simple disagreement, it's a fundamental split on the company's very survival. The bullish expectation is built on Plug's pivot from a niche material handling business, providing fuel cells for forklifts at companies like Amazon and Walmart, to a full-stack green hydrogen ecosystem provider. The company is now building the plants, producing the hydrogen, and selling the electrolyzers that allow others to produce it. The recent milestones are significant. The first 10-megawatt electrolyzer module has been delivered to the Galp refinery project in Portugal, and the company has secured a massive 2-gigawatt deal with Allied Green in Uzbekistan. Back home, its hydrogen plants in Georgia, Louisiana, and Tennessee are ramping up, and the company is in line for a potential $1.66 billion loan guarantee from the Department of Energy to build out even more facilities. Management has guided for $700 million in revenue for 2025. But the reality that challenges this expectation is found in the company's cash flow statement. The financial situation is precarious. In the second quarter of 2025, Plug burned through $230 million in cash. This was an increase from the $146 million burned in the prior quarter. While revenues are growing and gross margins are improving, moving from a staggering negative 132% a year ago to negative 55% in Q1, and then to negative 31% in Q2, they are still deeply negative. The company is spending far more to produce its hydrogen and equipment than it sells them for. This is the core of the bear thesis. Adding to this financial pressure is organizational instability. The company is navigating a major leadership change, with longtime CEO Andy Marsh set to step down, and the Chief Operating Officer, Sanjay Shrestha, resigned abruptly. This introduces significant transition risk at the precise moment the company needs flawless execution to scale its massive new projects and stop the cash drain. This is why the short sellers are here, and they are not a small force. They are an occupying army. The data on the short-selling activity is critical for any investor to understand. According to the most recent exchange data from Fintel and Nasdaq, the short interest in Plug Power is hovering around 30% of the float. Different sources report slightly different figures, from 29.59% to over 33%. But either way, this is an astronomical figure. It means for every 10 shares available to trade, 3 are held by someone who has sold them short, betting the price will go down. This is far, far higher than the peer average for the sector, which sits closer to 14%. The total number of shares sold short is massive, at over 330 million. Based on the recent heavy volume, this represents a days-to-cover ratio of nearly 4 days, meaning it would take almost a full week of trading for all short sellers to buy back their positions if they decided to, or were forced to, exit. What's your take on the 30% short interest? Is it a sign of smart money caution or a setup for a major squeeze? For investors, it's important to know where to look for this information. You can find official short interest data published by Nasdaq twice a month. More granular daily data can be found on financial platforms like Fintel or S3 Partners, which also track the cost to borrow. This is the fee short sellers must pay to borrow the stock, and it's a key indicator of demand. Curiously, while Plug's short interest is high sky, the borrow rate has recently been quite low, at times under 1%. This is an unusual and important detail. A high short interest combined with a low borrow fee suggests that while many are betting against the stock, there is also a very large stable supply of shares available to be loaned out, most likely from long-term institutional holders who are happy to collect a small fee while they wait, or who are also hedging their own long positions. This is not the hard-to-borrow dynamic that typically precedes a rapid squeeze. Furthermore, the off-exchange short volume ratio, reported by FINRA, has been consistently high, frequently hovering around 50%, which indicates that a large portion of the daily shorting activity is happening in dark pools, away from the public exchanges. We also have concrete data on fails to deliver, or FTDs, from the SEC. In late September, for instance, Plug saw significant FTD spikes, including one day with 4.79 million shares and another with 2.21 million shares that failed to settle. Fails to deliver can happen for many reasons, but large, persistent spikes can sometimes indicate settlement issues related to heavy shorting activity. This sets the stage for the retail crowd. On forums like Reddit and X, formerly Twitter, the sentiment is, as expected, polarized. You have long-term believers who remember the 2021 rally to $75 and are convinced the company's technological lead will eventually pay off. They see the short sellers as manipulators, actively trying to suppress a company vital to the green transition. On the other hand, you have traders who see the cash burn and negative margins and agree with the short thesis. The October 3rd rally was a classic example of this conflict. A bullish analyst note provided the fuel, and retail buying pressure, slamming against a 30% short interest, created an explosive upward move. The risk, of course, is that these are often temporary. As Clear Street's downgrade showed, institutions may simply use that retail-driven liquidity as an opportunity to sell their own shares or even initiate new short positions at a higher price. This is the danger of chasing a squeeze. The underlying fundamentals, specifically the cash burn, have not been resolved. Looking at institutional ownership from recent F-13 filings, we see this nervousness reflected. The latest filings from late October show a very mixed bag. While many smaller advisory firms are holding or adding small positions, we've also seen several institutions head for the exit, liquidating their entire stakes.